Hello everyone and welcome to BDO's Budget 2026 podcast. I'm Derek Henry, Head of Tax for BDO Ireland. We're fresh from the speeches of Minister for Finance Paschal Donoghue and Minister for Public Expenditure Jack Chambers. The two ministers entered Budget Day with a 25 billion surplus and strong employment figures. Despite this, we are seeing threats from US trade tariffs and the downgrading of international growth forecasts. Modified domestic demand is showing modest growth only. These factors, coupled with warnings from various bodies such as the ERSI, Central Bank and IFAC, have meant that the ministers were always going to have a curtailed budget. Overall, I would say we've seen this cautious approach to the package of measures that were announced, with a focus on targeted rather than universal measures. As promised in the summer economic statement, we got a package of 9.4 billion. However, it has been reallocated to increase the spending side by about 300 million to 8.1 billion, while reducing the tax measures by the same amount to 1.3 billion. Today we've seen measures for business, housing and very limited personal tax measures. This evening I'm once again joined by my colleagues Angela Fleming, Head of Financial Services Tax, and Cian O'Sullivan, Head of Private Clients Tax. Thank you both for joining us. Cian, I'll hand it over to you first. Normally we're talking to you about how has it hit our pockets and give us the good news, unfortunately.
Unfortunately, this is more about what they didn't include as opposed to what they did include. I think this time last year when we were sitting around the table, we were talking about an extra €1,000 into everyone's back pocket. This year it's nothing, and that's not a surprise because it was well flagged in the run up to the budget. And I guess they were keen to ensure that there were no measures that were going to further stoke inflation after getting that under control over the last number of years. But what that does mean is that as we have wage inflation and consumer inflation, without these reductions in tax, people are paying more tax and more of their income is going towards tax. And if you map from 2020 to 2025 and you take into consideration wage inflation and consumer price inflation, people are marginally less off. So notwithstanding the fact wages are going up and people were paying less tax over those years, the purchasing power hasn't increased. And that's why people still feel pinched, and that cost of living crisis is still very much there for especially that squeezed middle when you think about people and the cost of housing as that's increased in recent years, trying to get onto the property ladder. So
have they brought in any measures around the cost of living?
They have brought in some measures, but none of this is going to make any great impact. What's there is there was an increase in the minimum wage, and to ensure that people aren't going into the higher rate of USC, they've tinkered around the edges of the USC bracket at 2%. It's not going to have any dramatic effect. On the cost of living side of things, helpfully they've extended the 9% VAT rate for electricity and gas, but again, nothing major to write home about. On the tax rate and investments, I know Angela, you're going to talk about that in more detail. That has been reduced for certain investment products from 41% down to 38%. On the social welfare side, there's been a €10 increase in social welfare payments. Child support payments have increased also. And then to bolster the property related measures, the renters tax credit, so there's a €1,000 tax credit that people can avail of. That's been extended out. That was due to sunset at the end of this year. So that's been extended out for another 3 years. So that's great for people who can claim that credit. And similarly on the mortgage interest relief, that was introduced a couple of years ago to help people whose mortgage interest payments have increased in recent years. Where that's the case, you can stand to get a max relief of 1,250, which is quite considerable. That also was due to end at the end of this year. They've pushed that out for another 2 years. So welcome measures on the kind of the consumer side of property. Housing was obviously a very topical issue as part of the budget. What do you think of the announcements today?
Yeah, some interesting announcements on housing, particularly the VAT rate. That's the big one. It was flagged. So they've reduced the VAT rate on the construction of new apartments from 13.5% to 9%. We're well aware that there's a viability gap in the apartments whereby the cost of building them is much more than what can be achieved in the market. So this is a step to try and alleviate some of that viability gap. So for an apartment that's been sold for 300,000, that's probably a saving of about €12,000, which will go to some extent to address that gap, but won't go the full way. There are some other measures on infrastructure side and, ESB and water supply, various things that again are hopefully will reduce the cost of delivery of apartment and increase that supply. So coupled with that, it's an interesting move. There are some other measures that were brought in to help on that viability gap. So they have introduced an enhanced corporation tax deduction for the construction of new apartments, or where you convert existing non-residential into apartments, you will get this enhanced deduction. We don't know what that enhanced deduction is yet. We'll see that in the finance bill, but it's probably 120 or 150% of the cost will be deductible for tax purposes. So again, will help in that viability gap. Additionally, they've introduced a corporation tax exemption for cost rental units, where you earn rents from a cost rental in a corporate, that will be exempt from tax. A lot of the cost rentals are actually owned by the LDA or approved housing bodies. So this measure is very much to encourage private landlords into this sector. So we'll see if that has impact. In relation to other tax measures relating to property then, on the residential zone land tax, the Minister noted that he felt this was being successful in achieving its aims. So what he's doing is maintaining that, but he is giving landowners an opportunity to rezone their land next year to reflect the genuine economic purpose that the land has been put to. In relation to the residential stamp duty refund scheme, he's extended that out to 2030, which is welcomed, but additionally he's added in extra time limits into when you can claim that relief, and he's also accelerated payments for multi-development units where you can get your first payment on the commencement of phase 1. So that will help with the financing of the delivery of later phases. The retrofitting deduction for landlords has been extended for a further 3 years, which is welcome. He's also extended the period of the Living Cities initiative to 2030, which deals with investment into residential within cities, and he has broadened its application. So initially it was for renovation to house or buildings that were constructed before 1915. He's now extended that to any properties that were constructed before 1975, which is, brings a lot more into the net on it.
Significant, yeah.
Yeah. And the scheme will also apply now to living over the shop initiatives. The cap for the scheme has been increased from 200,000 to 300,000 as well, so there's an additional 100,000 there, which is welcomed. And finally, in the future, it will be extended to other regional centres which are under the National Development Framework. That will be to Athlone, Sligo, Letterkenny and Dundalk and Drogheda. So they're the 5 centres that will also be included in the scheme in the future. The last measure that was introduced is the derelict property tax. And this is going to replace the derelict site tax, which has been on the books since 2022. We don't have much detail on this one yet. What we do know is it's not going to be less than the vacant site levy, which was 7%. And we know that he's going to bring legislation forward in 2026 in relation to this matter, and then there's going to be a register in 2027. So it's more a long-term measure that's going to be brought in. Again, an attempt to bring some more stock back into the market. I guess, overall, I would say some significant changes, particularly the VAT rate on property. That's a significant one. So we'll see how that has impact. I guess, sticking on the VAT, there are some VAT on business initiatives that have been brought in. Angela, do you want to bring us through some of those?
Yeah, sure. So I think it was well flagged in advance of the budget that they were looking at a reduction in the VAT rate for elements of the hospitality sector, so predominantly the food and catering sectors, and also hairdressers as well. So that was announced today. Like I said, no surprises there. I think, what I would say about that, Cian mentioned already things like increases in the minimum wage. The cost of doing business for businesses has increased substantially in recent years. Also things like auto enrollment as well. So, it's great for these industries to get targeted measures, but it doesn't address, I suppose, that kind of wider cost of doing business that a lot of small businesses are facing.
Are there any measures in there that are kind of have broader applications?
Yeah, so there's some positive measures that we saw today. So the first one, the R&D tax credit has been increased yet again. So it's going up now from 30% up to 35%. And that will be, the R&D tax credit is a fantastic tool in Ireland's tax toolkit for businesses. And, that kind of just increasing the rate impacts businesses of all sizes. So small and large will all welcome that. But again, back with the targeted measures, as well as increasing the rate, they've also increased the refund amount that a business can get in its first year from 75,000, that's now going up to 87,500. And that is something that benefits smaller businesses. So that will be very welcome. Another change that was announced today was in around the dividend participation exemption regime. So you'll remember last year we spoke about this. It was introduced. We were kind of well out of sync internationally with not having a participation exemption regime in Ireland. So that came in, which was great. But there were some, I suppose, criticisms of the regime in terms of it was very narrow in terms of its geographical scope. So we've seen a little bit of movement on that today. So broadening that out so that it is now dividends that are coming from a jurisdiction that has a non-refundable dividend withholding tax.
Step in the right direction.
It's a step in the right direction. Doesn't kind of fully go the whole way in terms of addressing double taxation, but a step in the right direction, as you say.
Very good. And there's a couple of roadmaps and consultations announced as well.
Yeah, lots of roadmaps, action plans, consultations,
Compasses.
and even a compass. Yeah, that's a new one. Yeah. So yeah, look, I think it is important when you're introducing new tax measures that you do have a level of consultation, right? Otherwise, you can end up with unintended consequences, or you don't get, new regimes that actually do what they say on the tin. And we have seen that with some other measures that have been introduced in the past. They sound great on paper, but when we actually go to implement them, they're not fit for purpose. So it is important to have consultation. The only problem, I suppose, with consultation is that it takes time. So some measures that you might want to see implemented now or announced in this budget are a consultation. So there will be next year's finance bill, and probably I think the biggest example of that we've seen today is in around the taxation or the tax treatment of interest. So last year, we spoke about this and it was announced then, and we would have hoped that we would have seen something in this year's budget or finance bill, but it looks like that is going to be kicked down the road further, and it'll be next year before we see some substantial changes around taxation of interest.
A little bit disappointing. I suppose, Cian, maybe is there any other employer-related matters that will help on the cost of doing business?
There was some tinkering around the edges of some reliefs that already exist, really just extending them out. So they're not going to have a major impact on the cost of business front. They're welcomed, but again, back to the point of that pressure that SMEs are facing, while the 9% reduction for the hospitality sector is welcomed, what about the other businesses in that space but not in that industry? And again, the increased costs that they're facing and what measures of relief are there to help them navigate these issues. So more could probably have been done around attracting, retaining talent, around encouraging investment in the sector, and that hasn't been introduced. What was introduced was an extension of KEEP, which is a measure of relief for giving share options to staff. Again, I don't think extending this relief is what's needed unless there's more radical changes forthcoming in the finance bill. The take-up on this has been very low. We talk about it a lot with our clients, but actually putting it into the practice is rare. And I think the stats from 2022, or the latest stats, are that only 20 companies have implemented it to date since it's been introduced. So I think it's an example of a lot of new measures that have been introduced, but they've been so clouded in conditions that they're almost inoperable. Another one that was extended was SARP, so that attracts high-paid executives into the country, which is good for our FDI sector. One welcome change that wasn't flagged was CGT Entrepreneur Relief, an enhancement to that. So that gives a special 10% rate on certain qualifying disposals up to $1 million. That $1 million has been increased to 1.5 million. So again, hopefully that will encourage entrepreneurship and some activity into that space and investment in SMEs. And I guess on the theme of encouraging investment, that was one of the central aspects of the Fund Sector 2030 review around the retail investments. There were some announcements on that, Angela. What are your thoughts?
Yeah. So today they announced a reduction in the exit tax for investment funds from 41% down to 38%. And look, that's a very welcome announcement. What I would say the call was to reduce it down to 33%, align it with CGT rates. So that would have been better.
But simplify that whole regime, the tax in that regime.
Yeah, I think so. I'm not sure if this is a first step with the intention of reducing it further, or if it is effectively a blended rate of the income tax and the CGT rate. So we'll wait to see what they do there in future years. But look, I think we have an issue here where, you know, Ireland is one of the leading jurisdictions in terms of investment funds. But when you look at Irish household participation in that sector, it's really, really low, and we're kind of out of step internationally and way below our continental peers. We have something like 180 billion of Irish household wealth tied up in deposit accounts that are basically earning nothing. So, you know, the key here is how do we unlock that, and how do we get investors, Irish investors, more comfortable with using investment funds and things like ETFs, which have grown massively in popularity over recent years. So this is like that, a first step towards doing that. I think there was also some comments by the Minister today of, you know, the Savings and Investment Union at EU Commission level are looking at doing, making some suggestions, and they have made some suggestions around introducing a new savings product. And the Minister's alluded to looking at that for next year. So that's a really welcome comment. And hopefully when we're talking again next year, we'll have some good news around that.
Maybe another roadmap or maybe another consultation perhaps.
Well, coming to that point, I guess, Cian, any things, and I'll ask you both this question, but I'll start with you, Cian. Yeah. Any missed opportunities in this budget that you would have liked to see?
I guess we both referenced that SME sector. The 9% VAT, very welcomed, but again, back to auto enrolment, it's an extra 1.5% that the companies are going to be facing, the minimum wage increase, and that's not just for people at minimum wage, it has a knock-on impact to all salaries across the board for employers. And then there was also a 0.1% PRSI increase, which is going to be happening year on year over the coming years, that went into force last week and slightly under the radar. So what else is being done to help businesses face these rising costs? And again, you know, the broader backdrop to this budget is the need to support entrepreneurship, maintain our competitiveness. You know, the international landscape is uncertain, and we need to look inward a little bit more. So I'm not sure there was enough measures there to support that. Secondly, then, the measures that are already there, there are some really good incentives, there are some really good reliefs, but they probably just lack the teeth to have the impact. And I think it's possibly as a result of there being too clouded in conditionality and not having the impact that they're designed to have. So for instance, we often come across issues where exiting shareholders are subject to income tax, whether that's on a buyback of their shares or trying to pass their business on to the management and have a management buyout. Because of the way the legislation is designed, their exit gets subject to income tax. So that's surely an unintended consequence, and we'd like to see some changes in that space to encourage succession of businesses, to encourage growth of businesses, and really go after this SME sector. And then lastly, on the area of CGT and CAT, there was some talk of maybe blending the thresholds into just one threshold, but there was no announcements of that, and I think that would have been welcome to just simplify the regime in that space. So
plenty of opportunities in the coming years.
I think so, yeah.
Angela, for you, is there any missed opportunities?
Yeah, look, I think we spoke earlier about, you know, the various roadmaps and consultations, etc. I think last year it was a pre-election budget, so, you know, it was a bit of a giveaway budget. This year it's the first budget of a new government term, and I think, you know, the government are looking at it in that context. So it's, you know, step one of 4 years. And it means that what we're getting is a lot of kind of tinkering around the edges and no kind of big radical kind of announcements that are really going to make a big difference. And I think when we look at the global context that we're operating in, you know, Ireland being a small open economy has served us very well historically, but we're seeing a lot more kind of protectionism globally. So do we need to do something a little bit more radical to try and combat that and
competitiveness.
keep our competitiveness. So I would have liked to have seen something a bit more
impactful.
No,
very good. Firstly, I would like to thank Angela and Cian for their summary and insights this evening. We've seen some positive business measures in Budget 2026. In particular, the increase in the R&D tax credit and the VAT rate for hospitalities are very welcome. The introduction of the reduced rate of VAT on new apartments is a bold measure, and hopefully will, alongside other investments in infrastructure, will go some way to assist in the viability gap and hopefully improve supply. However, it is very important that the domestic sector is supported to be as strong as possible, and we feel that there's a number of missed opportunities. However, on balance, we feel that this is a more business-friendly budget than in recent years. As always, BDO stands ready to help you navigate any of these budget measures. So if you need further details, please reach out and we'd be delighted to be of assistance.